You're listening to the Practical Wealth Show with Curtis May.
All right, everybody, welcome to another episode of the Practical Wealth Show. So I'm excited. We have another great guest for you today, and special guest. So I have Miss Lindsey Johnson. Lindsay currently serves as the President of the U.S. Mortgage Insurers, USMI, and is the nation's leading private mortgage insurance association, comprised of 5 of the 6 U.S. mortgage companies in the country. So what we're going to talk about today is the mortgage banking industry, because y'all need to know, a lot of you are real estate investors, so you kind of need to know what's going on with that. And then we're kind of going to jump right into, that as we record this, we're in the midst of the COVID-19 crisis. And so how is that affected? How do you respond or prepare for that? What's going on. So, Lindsay, welcome to the Practical Wealth Show.
Thank you for having me, Curtis.
My pleasure.
Excited to be here.
So, Lindsay, you're quite accomplished. I know people don't like to talk about themselves, but tell them what I didn't tell them, and then let's kind of get into teaching our people what's going on.
Absolutely. So, bottom line is I've kind of crossed the different worlds. Live in DC, so have done the policy thing on Capitol Hill, on the Senate Banking Committee. I've been at a Federal Home Loan Bank, which is sort of one of the other government-sponsored enterprises. People usually hear about Fannie Mae and Freddie Mac, but there's also a Federal Home Bank system. So I worked with the Federal Home Banks. I was at PwC for a little bit of time, and then came here at U.S. Mortgage Insurers. And, I love my position here. I get to work alongside some of the just smartest individuals in the industry space, in the mortgage industry space, who are just simply passionate about what we do to help enable homeownership for millions of Americans. So all the policy stuff and everything else has been a fantastic sort of lead into what I do in my current position. And it is a really good spot to be. And the industry, and we'll get into this, is it's a sort of a bright spot right now in housing, despite kind of everything else that's happening in the market. So we'll get into that, but that's kind of my background.
Okay, well, that's good to know. So here's one thing I found interesting, and I kind of want to lay this out. So the goal is to advance the value of private mortgage insurance and to promote sustainable housing, a housing finance system backed by private capital. Okay. Mm-hmm. And so what is that different from the current system? Or is that can you explain that part of it before we jump into the other part? When you said,
you hit the nail on the head. So basically, about 60 years ago, the first private mortgage insurance company was born. And the thought process was, look, the Federal Housing Administration, FHA, does mm-hmm. really good stuff, but there's got to be a more competitive option out there. And so private mortgage insurance was born. And the reason the mortgage insurance is necessary, whether you get it through FHA or through private mortgage insurance, is because the lender views those borrowers, and there's tons of data to back this up. If you're not bringing a 20% down payment to the closing table, then you are viewed as higher risk, because those borrowers typically have a higher probability of defaulting on their mortgage. So private mortgage insurance comes in and we fill that gap, and we help that borrower achieve homeownership sooner than they otherwise could. And by doing so, we're not just helping the borrower, we're helping the lender, because that lender wants to make loans in their community. It's just a risk that they're trying to measure and size and accommodate for. And of course, we're helping taxpayers, because we stand in front, we take first loss mortgage risk in front of the government-sponsored enterprises, primarily Fannie and Freddie. And so, for example, through the last financial crisis, we paid about more than $50 billion in claims to the GSEs for those losses. So it's a really important role, and it kind of crosses all different aspects, from the homeowner to the lender to taxpayer. So it's a very important and necessary role.
Okay, so the goal is to provide, part of the goal is to create an option other than government-sponsored mortgages, to create competition in the marketplace for the consumer.
That's right, yeah.
Okay, and so now let's back up. Let's tell them what is mortgage insurance and how does it work? Let's start with that. Let's go to the basics.
Yeah, so again, kind of let's say that you're thinking about buying a house, and you're um, thinking through all that's going to be necessary to make that purchase, borrowers who can't put down the full 20%, again, are going to be viewed as higher risk. And there's actually a requirement for loans that are going to go to Fannie and Freddie to have some kind of credit enhancement. Private mortgage insurance is the most widely used form of credit enhancement. There's other options, but we're the most widely used form of credit enhancement because we work with all the different lenders, the 3,500 plus lenders out in the market today. We're plugged in. It's very seamless. And we, again, sort of bridge that gap. We've existed for more than 60 years. In those 6 decades, we've helped about 33 million people become homeowners sooner. And so it's really just this very seamless process. There are claims, and we'll talk about, events, and it's typically if a borrower, gets divorced or loses their job or something like that, that's an unfortunate event, and the homeowner loses their home, we pay that claim to protect the lender.
Let me break it down a little bit more. So now let's go to, I'm getting ready to buy. So this is for residential. You're trying to buy a house to live in.
Yep.
Okay. So, and I've heard you talk about the myth of the 20% down payment. So I'm buying a $200,000 house. 20% of that is like $40,000, right? 10%. Right. Okay. Yeah. So most people don't have enough money in their account to, if
40 grand.
Right. Yeah. If you walk, most people, if they walked out their door and all 4 of their tires were slashed, that would be a problem. Okay. So they don't have the liquidity. So now they want to buy a house, because I'm still trying to make sure people get this. So now I'm applying for a mortgage, and boom, y'all come in.
Yes.
Mortgage insurance comes in where?
Absolutely. So let me just kind of break it down even more. So one of the examples I love to use is, you take the average home price in the country right now, which is about $275,000. You're going to the closing cost, and if you think about how much you would be required to put down if you were putting down 20%, you would have $63,250 you would need in cash to the closing table. If you were using a 5% down payment, which is on average sort of the most widely used product in the private mortgage insurance space, the difference you're going to make now is about $13,750. Think about that, 13,000 versus 63,000. Like, it is a game changer in terms of someone's ability to actually get into the market.
Absolutely.
And so your monthly MI payment is going to be about $115. And that's added to your monthly mortgage payment. But then over a period of several years, usually between 5 and 7 years, the mortgage insurance payment goes away. It's canceled because the homeowner has actually reached enough equity in their house that they no longer need mortgage insurance. Now, that is one of the differences. And again, we always encourage people to be familiar with the different low down payment options. Well, first, to know that there's low down payment options out there. That is a huge key. And I'm always surprised at the number of people, and there's survey after survey, that say people don't know that there's low down payment options out there. So know that there's like 50%. There was a survey by the realtors just at the end of last year where 50% of the people surveyed thought that they needed 20% down to actually purchase their mortgage. So that's the first piece. The second piece is know your options, because there are differences and they're very meaningful. And you may go to the closing table and think, oh, well, I'm saving a few dollars here if I go FHA. And maybe FHA truly is a better option. But if you think about over the life of that loan, FHA premiums stay on your mortgage for the entire life of the mortgage. Private mortgage insurance can cancel, again, usually between 5 and 7 years. But that's several $1,000s that the consumer may otherwise pay.
That's a huge difference. I didn't know that. Okay, yeah, so if you get an FHA loan, this is a bullet point. Got to take notes on this. Okay, right. If you get an FHA, 3.5% down, 620 credit score. But what happens is you will pay for that as long as you live in the house.
That's correct. That is absolutely correct.
As opposed to private mortgage insurance, once you reach 20%, which could be through the appreciation of the house or debt pay down. Either one, or a combination of the two.
Exactly right. So we encourage folks, again, be aware of those different options when you go to the closing table, because the loan officer, they're doing a ton of loans a day, right? And they're just thinking, okay, I got to get this information. But being armed with that knowledge can help you ask the right question and help you sort of do the math on your own to understand long term. I might save a couple dollars a month over here, but in the long term, I'm saving thousands of dollars, and it is a much better option for me to go in this other direction. And oftentimes, private mortgage insurance will be more competitive even than FHA. And so, again, just kind of having that breakdown and understanding the different options is one of the best things you can do.
Yes, that's major, because see, one of the things that we teach is it's not just the cost, it's the opportunity cost, right? What would that
Absolutely.
dollar would have been worth had you been able to keep it? So you have to look at everything, because most people in the industry are very transactional, right? So they're
Yes.
just trying to, to say it politely, right? And they're trying to get you qualified so they can close the deal. So like in the mortgage business, nobody eats unless that deal closes. The realtor doesn't eat, the title companies, all that stuff. So they want to get it done, but you have to look out for, you have to, if we always say, if you know what's going on, you know what to do, you have to know the game. So it's hard to win a game you don't know the rules. So this
Right.
is a great episode because, this is arguably the biggest purchase that you'll ever make.
Absolutely. You said something, you said opportunity cost. And
Mm-hmm.
one of the things, again, that we try to just inform folks of, and this is not to say that you are always going to be in an appreciation market. We've seen house price appreciation for, since the financial crisis almost consistently. But that home price appreciation isn't always there, but it is something to consider. And that's what we constantly tell potential borrowers is think about home price appreciation. And that example I used previously of $275,000 home, that is likely to cost more in years ahead. So the same time that you're trying to save, if you were going to try to save for a larger down payment, just be thinking about, is that a moving target? Am I constantly going to be having to add more and more to that
Right, because
pot of
next year
money?
it could be worth it could cost
Absolutely. And
285. Yeah, because what
yes,
happens is, so this is when I talk about you got to understand macroeconomics, because the goal of the system of the Fed is inflation is their goal. And so where inflation kicks in is through asset prices. So you see the stock market go up, you see real estate going up, and that's where that comes in. So if you're trying to buy it and you're waiting, if there's a strong market, it's a moving target, as you said. So,
and one thing about the market right now, I think one of the biggest drivers in just home price appreciation, and on the one hand, it's been a challenge, and we've been not concerned, but I think that there are some concerning aspects of it in the sense that if you're a potential homeowner and you see prices in your market that you continue to try to save for go up, it is, like I said, it's that moving target. And probably the biggest reason we see home price appreciation across the country is the lack of supply. And that's not likely to change in the immediate near term. And so as we're thinking about home price appreciation, we're thinking about sort of what that means. I mean, that is something even through this COVID pandemic, we've seen home prices hold stronger than many people were ever anticipating they would, but that's really attributable to that lack of supply. And so again, I think that home price appreciation can be expected, at least in the near term. And that is another aspect that's, important just to consider in the back of your minds.
So we say lack of supply is lack of supply of housing stock.
Lack of supply and housing stock, and in particular, in that kind of lower to middle tier home price, like those are the homes that are just in hot demand right now. And you couple that with for a long time, especially after the financial crisis, people weren't moving as often as they used to move. People were kind of staying put. Builders were only doing sort of the biggest homes. So the upper end of the market was decent, but that middle tier and that beginner sort of starter home market was just extremely compressed. And that, you saw it in Seattle, you saw it in, areas in Colorado and sort of those booming markets. People trying to break into that market were having a really hard time, and appreciation continued to go up because of that lack of supply. And that's going to take a few years to kind of work through, and people are still trying to kind of think through how do we bring more supply to the market. But that should just, again, it's just another piece of information that I think helps inform folks.
Yeah, I
who are
told you I
looking at
can
the
nerd out
market.
on macroeconomics. So I'm this helped me a lot. I don't know about y'all.
All supply and demand.
Right. So let's talk about, so you brought up COVID-19. So let's how, from your perspective, is that affecting the industry, the mortgage real estate industry? What are you seeing, and what should
Yeah.
we be thinking about?
Well, I mean, it's a topic on everybody's mind right now, of course. And I think coming out of the financial crisis, the government has focused and when I say financial crisis, the 2008 financial crisis, the government had focused for years on ensuring that the housing finance system was stronger, it was more robust, stronger underwriting guardrails to really make sure that the lending market was serving consumers in a much more sustainable way. It is unbelievable to think that within a span of just over a decade, we're seeing a second crisis. But, this crisis, and I keep telling folks because it's so important to reiterate, is very, very different than the last time. The housing market is much stronger than it was during the last crisis. The industry is much stronger, from lenders to, mortgage insurance companies, servicers, regulators, also all, we all rallied together very quickly this time to identify the immediate pain points that we were expecting would sort of be the outflow of the impacts from COVID on homeowners. So even though this is a healthcare crisis, it will undoubtedly and is undoubtedly having significant implications for borrowers across the country who may temporarily be without work or who have to dip into their savings for a time period. And so policymakers have really focused on helping borrowers who were directly or indirectly impacted stay in their homes. That was sort of the first goal because, by and large, especially over the first few months, you would do these surveys out in the market, even though you'd see these job numbers, surveys would consistently come in, and upwards of 85% of those individuals were saying they expect to go back to their same place of employment. So overall, there is an expectation most borrowers are going to go back to their places of employment. And as this drags on, we all kind of look at that and continue to assess it. But those fundamentals were strong, and so that forbearance and giving borrowers that time out on their payments made a ton of sense. And that was available to both individuals who had their loans backed by either the Federal Housing Administration or Fannie and Freddie. So it was, the vast majority of borrowers were sort of covered under this. And the market's doing really well right now, or as well as definitely surprising most folks. The spring purchase market was better than we might have thought. Clearly, there were some bumps. People did pull their houses off of the market, if they were listing them, just because a lot of folks didn't want people walking through their homes and all the different challenges.
Biggie. Yeah,
It's a huge issue. But on the purchase side, it really has held its own through the spring. I think, again, kind of pointing back to those two basic housing fundamentals, the demographics and the rates. The largest demographic group, millennials, are coming into that home buying age, and rates, which have continued to remain low and actually dropped over the last few months, have really just driven demand like we were not expecting to see through the spring and summer. And then on the refinance side, as of a few weeks ago, there were almost 5 million households that were in the money and able to refinance because of lower rates. So we've seen a refinance boom through the summer that has been, it was 60% over what we've seen just last year. So it's been a phenomenal refinance boom. But one thing that we do know is coming out of this COVID-19 pandemic, even though that was a very optimistic, sort of view of what's happening, there is still a lot of pain, and there's still a lot of folks who are, like I said, either temporarily without their job and income, or they've had to dip into their savings. And so we know that low down payment lending is going to be critical coming out of this crisis, more critical than it was even going into it. And you think about the fact that about 80% of all first-time home buyers put less than 20% down in 2019. My expectation is the demand for those products, that low down payment lending, is only going to grow over the next, say, year to 5 years, because people, that's kind of the timeline expectation of the impact of this virus. So, we continue to work with policymakers. to really focus in on ensuring that those low down payment options are available and that we're helping consumers sort of bridge that gap in the right way. And like I said, some of those forbearance programs and other ways that policymakers are addressing current homeowners are critical, but then also thinking about future homeowners and making sure that they are also not going to be locked out of the market, have ample opportunity as the other side of that coin.
I want to step back for a second. I meant to ask, I want to clarify this. So how does so there's two sides of every coin, right? So the mortgage insurance helps the consumer who doesn't have 20% since they have that, how it helps the lender if they feel like if you don't have 20%, it's a risk, you're risky, and the mortgage insurance protects the lender because you don't have enough skin in the game. What's the thought process behind that?
Yeah, I mean, it really is because, lessons learned over time, right?
Mm-hmm.
And I mean, again, kind of goes back to decades of data that have demonstrated that down payments do matter.
Mm-hmm.
And so whether you're going with the Federal Housing Administration or you're going with a lender, there is going to be some kind of requirement. If you're not going to bring 20% to the table, they're going to either charge, if it's not a loan that's backed by the federal government through FHA or through the GSEs, even if you're just going with a private lender, your rates are going to be different if you're not bringing more down to the table. So there's some accommodation at some point for those borrowers. And, a very long time ago, it was conceived that, look, there is a type of insurance that we can pay that borrowers don't have to lock it in for the entire life of the loan, that they can just kind of bridge that gap until they get that 20%. And then the lender feels, very comfortable with that borrower going forward. And so again, sort of emerge this industry, very capital intensive, because as I mentioned, if you do hit a crisis or if there are real troubles, you want to make sure that you've got entities who are able to not just provide capital, a pot of capital, which is important, right? But we also serve as a second set of eyes. And that's something that we've really stressed post the financial crisis is it is really essential that if a borrower is coming into the market, we've gotten rid of, since the Dodd-Frank Act, we've gotten rid of things like no doc and liar loans and things that just made absolutely no sense.
Right.
But it's also essential that we as insurance companies who are taking the first piece of that risk after the borrower's down payment, we want to make sure that borrower, when he comes into the door, is able to repay his mortgage. And it's just sort of the basic fundamentals of lending. But, it's been very good since the financial crisis, but things change and things get looser over time. And so making sure that those second pair of eyes are in the market and that we sort of flag things when we see them, and if we've got concerns, and there have been instances, even since the financial crisis, where the industry has done this, where changes were made. We saw the risk that was coming through the door, and the volume is, of course, significant. So we have to act quickly and say, look, this doesn't look right. And we'll raise our hands and we'll say, we don't think borrowers are going to be able to repay in these situations, and adjustments are made. And that's how the system should work. You want to make sure that people who have real skin in the game are giving that input and making sure that those guardrails are in place so that the system's not harmed, but also borrowers are not harmed.
Yeah, I mean, it goes back to private capital. See, if you're putting your capital at risk, you're not, because what happens is, going back to policy, policy started because if you mandate, all right, everybody must own a home, well, when you're ready, okay?
Right.
You've got to be able to buy a home. You can't legislate success. So because if they're not ready, I used to do mortgage back in erupt to the crisis, right? Well, I was adding it to my financial planning business. So I became a mortgage planner. So I used to do class. I would say, look, I would take people through the 1003, because I'm prepping for the next question, because for my millennials listening, what does it take to qualify for a mortgage? But one of the things that I would talk about is that this is a financial statement, the 1003, and that you have to, they're looking at your finances. Do you save? Right. Do you have good credit? Meaning that, what's a credit report? That's a written verification of your integrity. So I used to tell people, like, did somebody loan you money? Did you pay them back? Okay. And if
Yep.
you didn't pay them back, it's like, well, why the hell should I loan you my money if you didn't pay anybody else back? What makes you think you don't pay me
Right.
back? And so I was doing them in South Philly. So I had to break it down. Like, look, I was saying stuff like, what the hell was it? I used to tell this story about, I'll tell it. So my family had a bar, right? So we come into the bar. I would explain to people how credit score works. And this guy comes in. I kind of knew him. So the bar was kind of in the hood, right? So he goes, Kurt, will you loan me $20? I'm good for it, right? Okay. Let me take you through the C's of credit, right? I was like, all right, he needs $20. Is he working? No. Does he have the ability to pay? No, he does not. Okay. Character. Okay. I don't really know you and you don't have the ability to pay. You need $20. Your loan is denied, right? Unless I'm going to make it a grant, right? And that is so that's how I explain the credit report. I said, and if you're in the neighborhood, he owes people money, and you loan him money, then if you are not going to give it away, he's not going to pay you back. It's not working, and he hasn't worked. So that's an extreme case, but that's just like, and so my lending decision took all of less than a split second. Your loan was denied. Oh man, I'm sorry, I can't help you. I can't even pay attention, So basically the loan denied, right? And but so what does it take to qualify for a mortgage? So I'm like football season where it start in Philly, the Eagles are practice. So I like blocking and tackling. I want to take people back to the basics. And then,
and this is a good question. And, a lot of folks, so there's that fundamental, what you just said, and that is from a lending perspective. I mean, if you broke everything down in the system, that is the foundation, right?
Yeah.
So people want to know that they're going to get paid back. They want to know that if they're going to lend the money, they're going to charge a little bit of interest for lending that money. Like, it's just the fundamentals, right?
Yeah.
But the thing that I think surprised me, and, I think where there's a sophistication that I didn't have, frankly, when I was going into college and kind of coming out of college. And the thing that I thought, because it was sort of pounded in my head, was like, don't get credit cards and don't do this and that. And I thought, okay, great. I'm not going to have credit cards. I'm just going to save. And I was doing really well in terms of savings, but my credit didn't exist. I was totally credit invisible. I mean, and so when I got married and I had that conversation, we were talking through that. I was like, oh, I don't do credit. I don't, and I was doing it as like a bragging, right?
Right.
And in the end,
I have no credit, which is almost as bad as bad credit. Right.
I have no credit. And that's not a good option either.
Mm-hmm.
So it takes a while, but I think one of the things that have changed since, the financial crisis, and in my opinion, a lot more work needs to be done across the board. I mean, in my mind, it should be in every high school class or a required course in college for every student. Is the foundations of credit. Yep. And understanding how to build your credit. What's good credit? What's bad credit? How do the reporting agencies and how do lenders look at a student loan versus a car versus a credit card, a consumer credit card? What are the differences, and how do you pay it off in the right way? And all those different things, because at the end of the day, that is a really important thing that as you're becoming what we call home ready, understanding your credit score is one of those big pieces. Understanding your savings rates. So there's something called debt to income ratio, right?
Yeah.
And lenders, that's lender speak. And I know Curtis is familiar with it, but for your borrowers who are not familiar, it's just your debt divided by your income and understanding that ratio. And it actually was put in to law through Dodd-Frank, and there might be changes over time, but just as a foundational thing is you as a borrower going to think about, what am I comfortable paying for a mortgage? It's that, okay, how much income do I bring in and how much of that income do I want dedicated to debt? And so that is just a baseline thing to be thinking about, because the lender's going to look at it and they're going to be thinking about it. So look at those things. How much do I have in my car payment and my child care and my all these other debts that I'm going to have each month, and really where does that stack up against my income? So know that before you go to the closing table, at least have an idea. Have an idea before you sit down and let somebody else kind of help navigate you, and they'll be very helpful through the process, but be thinking about your savings rate. how much am I saving every month? How much will I be able to save at the end of every month if I purchase whatever this home is? And how much do I want to bring to the closing table? It's such a hard thing to save for a down payment. And I've been there, and it's really difficult to do it. What's almost as difficult, as excited as you are about that home, is the thought of, I'm going to turn my savings over. Like, I worked so hard for this. And so making sure that you've got a cushion in the bank and not turn over all of your savings to get into that home, because I can promise you, the minute you do it,
go wrong. That's
something's
right.
going to go wrong. Your tire's going to go flat.
You cannot. You have to. In my fact, one of the things they look for is reserves. Right after.
Yes.
After you buy the house, you can't be your last dollar, because something's going to go wrong. So you've got to build your reserves up, and that's most when you look at the. I always tell people during the last crash, when you look at why people lost your house, it goes back to bad financial planning.
Yeah.
And because you were buying a house you couldn't afford, but you didn't know your numbers. See, because I always tell people, look, just because you qualify for a $300,000 house doesn't mean you're supposed to buy one, right? Because your debt ratio shouldn't be more than like 30%. See, because we teach our clients that I want you saving 15% or more of your gross income is what we help our clients do. And we teach different places to put that, but there's a difference between saving and investing. So that 15% is not your 401k. I'm talking about savings, safe, liquid, you control, can't lose money, and so not tied up behind a box that you can't touch for 30 years. That's a different strategy, Lindsay. That's one of my pet peeves. But it's so important that what you're saying is that you look at that. So when you're hearing this, and because insurance is great, because insurance transfers risk, right? And so the lender has a risk, and because of the mortgage insurance, we're trying to pull this all together, they're allowing you to get in a house without 20%, but you got to make sure, because getting a house is easy, okay, in a sense, because everybody wants you in a house. The state wants you in a house, the city wants you in a house, because it builds their tax base, right? But keeping it,
right.
That's the problem, and what do? Because, you could lose your job, you could get hurt, you could lose your income, stuff breaks. And see, so that's disability insurance. That's, 3 months of emergency fund. That's, because you still need if you bought a house, you still need to be able to save 15% of your income. And so you have to look at that. I'm sorry to talk too much, because I'm interviewing you, but you triggered me.
This is you hit the nail on the head. I mean, so one of the things that our industry did, again, we work primarily with lenders, right? If you're a consumer, we want you to know about private mortgage insurance. And again, kind of goes back to being home ready, which is know about yourself, know your numbers, and then know your options. Know, again, that difference between the FHA and private MI, know the different products that are out there and available to you. All those things are essential. We looked at this and we kept reading these surveys, and there are, thankfully, many resources out there now. We put something together, and, we hope it's a sort of a comprehensive overview of some of what we've talked about. It's called lowdownpaymentfacts.com. Okay. It brings together some of the latest data and trends. It talks about, what borrowers are doing and the impact it's having on their savings. It talks to you about your credit score, about a number of these different things. So lowdownpaymentfacts.com, great resource. There's others out there, but we just encourage people to, to look at those different things before they, and as they're thinking about, maybe even a year down the road, I'll want to purchase a home. Start now. Start looking, start thinking about what the home prices are. You're going to, realize what's a good opportunity and what's a good deal if you start your homework now and understand and sort of stick to your numbers and what you feel comfortable doing.
Yep, that is good. So we're going to put that in the show notes, lowdownpaymentfacts.com. Lindsay, as we close, I appreciate your time today. Yeah. I think that we brushed out some really good points. Anything I should have asked you that I forgot. This is my catch-all to make sure I didn't miss anything.
No, I mean, I think that you're doing great work. I think that these conversations are the right conversations for all of us to have. It's, understanding, from a broad macro perspective for those listeners who are curious about the mortgage industry and sort of what's happening and the impact of COVID. We want folks to know that the industry is the entire mortgage industry, lenders, servicers, the regulators, mortgage insurance have all kind of come together. There's options out there to help consumers. But from the consumer side, also recognizing that coming through this crisis, literally coming through it, the market is strong and there's demand, and there's going to be growing demand for low down payment options. And so we want to make sure that folks are armed with the right information. And we appreciate you, Curtis, and others who are really delivering that information right into the hands of consumers. And so happy to be a resource and, excited to talk again in the future.
Who should reach out to you? I know you're on LinkedIn, and but you more so work with because one of the things I hear is that if I'm a mortgage person, if I'm a real estate person, I need to get to work because there's opportunity out there. Is what I'm hearing. But that goes back to marketing and not, sitting in a fetal position where your thumb in your mouth waiting for a vaccine before you go back to work.
Right.
Don't get me started. But so is that the best resource? Is with the low down payment facts.com, or if I'm more of on the institutional side, so that's where we'll go with that. So
and we also, if on the institutional side, if you're interested in mortgage insurance and updates in the industry, and USMI.org is our website.
Okay.
Feel free to reach out to me through LinkedIn. I'm extremely accessible. And then on the consumer side, lowdownpaymentfacts.com. But I also, for real estate agents, for lenders, for others, I think that is a great resource, even to share with your clients. And having something that can break it down for them. We've got videos out there. We really have tried to sort of break this information down in a digestible form because there is a ton of information out there. So that's a great resource.
That's a really good point. Awesome. Lindsey Johnson, thank you so much for being on the Practical Wealth Show. This was an awesome, very educational interview.
I was thrilled to do it. Thanks so much, Curtis.
You're welcome. So guys, thanks for listening to another episode of the Practical Wealth Show. We're going to put the resources in the show notes and make sure that you listen, like, and share.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted.